let's say gold does up. I'll round the number off because I think I'm probably going to be proven conservative anyway. So let's say we get 7,000. You get a 50% correction, takes you back down to 3,500. From there, you could see 20,000 in gold by the early 2030s. I have a long-term forecast of $1,000, but
Right.
that's out early 2030s. And because of the bust, I do believe this thing, wherever it goes, whether it's 180 or whether it's, you know, um, Michael Oliver's number of 3 to 500.
Hmm.
I think it'll have a blow off run here this year.
The precious metals market continues to attract attention as investors seek protection against economic uncertainty, inflation risks, and growing global debt concerns. Veteran market strategist David Hunter believes the current cycle may be entering its most powerful phase yet. While many investors remain cautious, he argues that skepticism is actually fueling the advance rather than limiting it. David Hunter, a longtime macro market analyst known for his supercycle research and market forecasts, explains that institutional investors have remained surprisingly reluctant to embrace precious metals despite their strong performance. In his view, that lack of enthusiasm suggests the biggest move may still lie ahead. He believes the current environment resembles the late stages of a major bull market, where momentum can accelerate rapidly before reaching its final peak. According to this outlook, gold could continue climbing toward the $7,000 area before eventually experiencing a significant correction. Silver, meanwhile, may deliver even stronger percentage gains due to its volatility and growing investor interest. The expectation is that precious metals will attract increasing institutional capital as momentum strengthens and more investors seek exposure to hard assets. Hunter also suggests that silver could experience a powerful parabolic move, potentially pushing well beyond previous highs. As market sentiment gradually shifts from skepticism to optimism, precious metals may become one of the most closely watched sectors in global finance. We're about to dive into highlights from David Hunter's interview. Before we begin, make sure to subscribe to the channel and enable notifications so you never miss our latest insights on gold, silver, the economy, and financial markets. Thank you, and enjoy the video.
People mistake my word bust for meaning the market's going bust.
Right.
And I say it's a bear market accompanied by a bust. The bust is the economy and the financial system, and the bear obviously is the market. So you can identify the top in the market, I think, when you see, as I say, when I see everybody's in, when people are talking about this bull run having 2 or 3 years to run, this bull market having 2 or 3 years to run, when people are kind of all over themselves wanting to buy, that will be my signal that we're getting very close to a top. We have not seen that. That's really what's fueled this long advance from 2022, is that particularly institutions have been skeptical all the way up. They started when it moved over 7,000. They started to get bullish the first time it moved over 7. They started finally saying, "Yeah, this is real," and they were raising targets, etc. And then Iran hit in the 1st of
Hmm.
March, and we had that correction. And people were tripping over themselves, coming up with lower estimates of how far down we were going to go. And the thing reversed, and we're now 74, 7,500. Um, and you still have that initial beginnings of bullishness move back to the skeptic side. And right now, you've got institutions pretty skeptical here, that this thing has much more upside. Some will say 77 or 800 or 7,600, but you don't see much above that. And there are others that have kind of said we've already topped. So I think there's plenty built up in that wall of worry that can switch over to bullishness as this thing gets going again. Well, if you're talking about the whole correction, it really went a lot more than a little high. It
Yeah.
went
Yeah.
from 50 to 120 in a matter of weeks. That obviously needed to get corrected. It was a parabolic run. Normally, parabolic runs are end of cycle runs or things that you kind of say, hey, maybe that was it. In this case, didn't have I didn't wait very long. It didn't cause me a lot of consternation in terms of, hey, is this the top? I just said, yeah, we need to correct. I thought we were going to get like a 35% correction in
Hmm.
silver. It went down 50% in that initial sell off. and we've been kind of back and forth in a consolidation ever since for the last couple months. I think we're pretty well done with that. I think we did consolidate that huge run, and I think we're poised for the next leg up, which will be, again, parabolic, probably even steeper than that one, or certainly similar. And that's how I get to 180.
Right.
And I'm not so sure that I'm not too conservative still. I have a long-term forecast of $1,000, but
Right.
that's out early 2030s. And because of the bust, I do believe this thing, wherever it goes, whether it's 180 or whether it's, Michael Oliver's number of 300 to 500. I think it'll have a blow off run here this year. Like I said, it could happen by Labor Day. It might take into the fall, but I'm not so worried about the number. My 180 is where I could get to on my work, but I don't discount the fact that it could blow right through that in a blow off and take you up to 250 or higher.
Right.
So I would not use that number per se, as much as to realize we're in I think a late stage for this cyclical cycle. For this cycle, I don't think we go beyond this year. And then because of the bust, pretty much all assets other than treasuries will go down.
Right.
Silver is very volatile, so that could go down, 50, 60, 70%. Gold probably less so, maybe 30 or 40%, but it could go 50 and this go 75. So there is a downside, I think, because of a global bust. If I'm wrong about the bust, maybe it lasts longer. But I think you've got some kind of a cycle end here this year, and obviously I think it's going to be a violent one. So that's why I am thinking this is very late in terms of that move. We've come a long way from silver down at $20, up to 120, and in this case probably up to 180, $200. So it's to me we're months away from a point where you have to make that decision, not years. Yeah, no, these are definitely targets prior to the bust and prior to the bear market. Well, like I said, it could happen before Labor Day for both gold and silver and for the stock market, but it doesn't have to. It could carry. We might even see it carry as far as the election or come close. So I'm not so worried about pinpointing that, but it's definitely pre-bust. And then you get that correction in the bust, and that should present a generational opportunity, because if, let's say, gold does up, I'll round the number off because I think I'm probably going to be proven conservative anyway. So let's say we get 7,000, you get a 50% correction, takes you back down to 3,500. From there, you could see 20,000 in gold by the early 2030s. So and the miners obviously have leverage to that. So there's another opportunity after this one, but this one still is far from over. There's a big run here.
A key theme in this analysis is the distinction between a market correction and a broader economic bust. While many investors associate a bust with collapsing asset prices alone, the argument here is that the real concern lies within the global financial system and the economy itself. If economic conditions deteriorate significantly, nearly all asset classes could face pressure, creating a highly volatile environment across financial markets. The recent consolidation in silver is viewed as a normal pause following an extremely strong rally. Rather than signaling the end of the trend, the correction is interpreted as a necessary reset before another major advance. Momentum remains one of the most important indicators. As silver climbs back above key psychological levels, larger institutions may begin allocating capital to the sector after years of ignoring it. This shift in investor psychology could become a powerful catalyst. Once major funds and wealth managers recognize the trend's strength, demand could increase rapidly, potentially accelerating the next stage of the bull market. Let's get back to the interview.
Yeah, well, physical certainly will be the more stable, and obviously supply demand, particularly with sovereigns being so interested in it, helps hold that up. I'm sure it will, trade down with the paper at some point. It's not going to deviate that much that it goes opposite. but it will be more stable and will probably come down slower. The ETFs, we saw this back in 2020. We saw this in 2008, nine, I think. But certainly, I remember 2020. You have two things going on. Then you have the underlying securities in that ETF under pressure. And then you have all those, and particularly we found out how much institutions use the ETFs. You have the liquidity problem of some big whales wanting to get out and get out in a hurry, and so the ETFs actually went down farther and faster than did the underlying miners that were in the portfolio. So that is a risk that I think you see anytime you have a big downturn. Um, and the miners themselves obviously have plenty of volatility and plenty of risk if the metals roll over. So it's pick your poison. They're all going down, I think. Obviously, physical less so, or less fast. But I think they're all going to get hit pretty hard. Not nearly, except maybe silver, not nearly as hard as equities themselves. I don't think a lot of central bankers or policymakers realize that there is a bust coming. I don't think if you talk to them, they have any idea that that's what's coming. They think 2008-9 was kind of the big one, and nothing like that's coming again. So they may worry about a downturn, et cetera. But I think they're buying gold primarily because of all the debt and money that has been put out there over since 2008, and particularly since 2020. I think people realize that fiat currencies are not the sound money story today. And obviously, we have things like the BRICS, looking to try to create a gold-backed currency, and China, I think, understands maybe pretty well what's coming in the future, and they want gold. So I don't think it's because they're worried about a bust. They're more worried about fiat currency. I don't have any that can tell you that. I mean, I think it's both. Frankly, I don't think institutions have yet really warmed up to it.
Yeah,
it's been for the longest time. Gold was not even looked at as an important piece of portfolios until recently, and so then they say, oh, maybe you should have 5 to 10%, and some people 20% in gold. Silver, I think, is far less looked at as something that institutions need to have in their portfolios, or wealth managers have to put in portfolios. What happens, I think, is momentum starts, attracting attention, and institutions start moving away from kind of stubbornness of saying, yeah, we don't need silver. It doesn't fit our parameters. And they start realizing that, it's a runaway freight train in terms of momentum, and that they should be on board. So, as always, I think psychology plays a role both for retail and for institutions. But frankly, I don't think they've really. Obviously, there are institutions out there that are buying, but I don't think in main part there are all that many institutions that are really paying much attention to silver at this point.
yeah,
I think as we move into this next leg up and get over $100 again, I think that run from 100 to say $200, because I do think my 180 is going to prove low. I think in there you will see a lot more institutional buying, and that's part of that run up. If gold's on its way to 20,000 late this decade, early next, and you're trying to figure out how do you tie it to your currency. It's going to be an expensive proposition to do. So I think it's let me put it this way: the Austrians have been talking about reset for a long time, and like it's right around the corner for a long time.
yeah,
I think it's more likely we see a reset middle of next decade when everything comes crashing down, because this global bust is not that depression. I think we're at the end of a super cycle, which I define as a long cycle between two depressions, the 1930s being the last depression. I think the mid 2030s being the next depression. And it happens to be 100 years. It's not. I'm not doing it based on that, but I think if we get what I'm calling for in terms of global bust, and the inevitable response to that is 20 trillion from here and 50 trillion maybe from the central banks overall or whatever, um, you're going to see inflation, I think, by early next decade in the 25% range. I was around as a pension fund equity manager back in the early 1980s when we saw 20% inflation. I think we're going to exceed that, and in this country.
Hmm.
So 25% inflation gets you, interest rates probably up in the high teens. And if you have interest rates in the high teens and you have, debt, global debt, which is say 330 trillion today, could be 450 trillion or more after the bust, because of all that will happen during the bust, mostly sovereign. And obviously government debt here that's through the roof. You can't solve that equation. We can't service our debt at 5%. I don't know how we're going to service it at 15 or 20%. So that's where you then can get a collapse following that. And it's in that collapse, which will, I think, be far bigger than the 1930s. It's in that you're going to be rebuilding whatever and starting from scratch.
Mhm.
I think you could see something then, but you could also see a lot of other things, including totalitarianism and anarchy, et cetera. It's hard to know what will come out of something as dire as that.
Looking beyond the current cycle, the discussion becomes even more ambitious. The forecast suggests that a powerful bull market in precious metals could eventually be followed by a severe global economic downturn. Massive debt burdens, expanding government deficits, and aggressive monetary responses are viewed as conditions that could reshape the financial landscape over the next decade. One of the more notable predictions is that gold could eventually reach $20,000 in the early 2030s after a major correction and subsequent recovery phase. Silver is also expected to benefit from long-term monetary and investment trends, with the possibility of prices moving far beyond traditional expectations if institutional participation expands significantly. The broader thesis is that future monetary stimulus, potentially measured in tens of trillions of dollars globally, could create inflationary pressures much stronger than those experienced in previous decades. From this perspective, precious metals are not simply trading vehicles, but strategic assets positioned to benefit from long-term currency debasement and financial instability. While the path is expected to include significant volatility, the overall outlook remains strongly bullish for gold and silver over the coming years. Investors who understand the larger macroeconomic picture may be better prepared for the dramatic shifts that could emerge as debt, inflation, and monetary policy continue to shape the global economy. We'd love to hear your perspective on the ideas shared in this interview. Leave a comment below and join the conversation. If you enjoyed this video and found value in the analysis, please like, subscribe, and click the notification bell to stay updated with future content. Thank you for watching, and we'll see you in the next video.